Good morning. We're on to week 4 already. Man, oh man, look at that. We got 2 assignments due this week. So we're going to go over those. Again, the quizzes should cover things that are in the book, more terminology and those types of things. So I'm going to devote my time here to just kind of going over the assignments and hopefully helping you or showing you how to put those together. Later today then I'll do a video going through the next financial statements that I'd like you to work on for your project number 1. So let's start with chapter 4, and our assignment for chapter 4, our problems 1, 2, 5, 7, 12, and 22. I think I've got some samples kind of for each of those. So some of them I used, the same problem basically, but just changed the numbers on just to kind of show you how to set it up. So if we start with your problem number 1 for chapter 4, which is on page 113. Yep, 113. And it starts out, it says, Eli Lilly. They come up with some great names. He's very excited because sales for his nursery and plant company are expected to double from $600,000 to $1.2 million next year. Eli notes that net assets minus liabilities will remain at 50% of sales. So if his sales increase, obviously his net assets will have to increase. His firm will enjoy an 8% return on total sales. He will start the year with $120,000 in the bank. And is bragging about the Jaguar and luxury townhouse he will buy. Does his optimistic outlook for his cash position appear to be correct? Compute his likely cash balance or deficit for the end of the year. Start with beginning cash and subtract the asset buildup, which is equal to 50% of the sales increase, and add in profit. Okay, so again, I just kind of used some different numbers. Check, yeah. And plugged it in, but just to show you then how to set this up. So for you guys then, your beginning cash is 120, and I just picked 200,000, and I said that my sales increase is going to be $1 million. Your sales increase will be 600,000, right? Okay. And I used the same percentage here, though. I'm going to have to build up assets of $500,000, and so there's going to be a cash expenditure for that, right? I've got to spend cash to build up those assets. Those assets might be accounts receivable, they might be inventory, might be some combination, could be other things, buildings, plant equipment, etc., right? Okay. And then in my example, I'm going to use $2 million in sales and a return on sales of 9%. And your guys' sales are 1.2 million and your return on sales are 8%. So all this was just inputting numbers, right? Setting it up over here. I got beginning cash, sales increase, asset build, sales, ROS. So I've just input numbers until I get to here is the one formula that I have to do. And if my return on sales are 9%, what that tells me is that taking my sales number times 9% should end up being what my profit is. Okay, so this is simply a matter of saying this is equal to my return on sales times my sales, okay, or $180,000. Now, I put these in 2 columns because when I get here, I've got what my beginning cash is. I have what my asset build is going to take, and that's a negative cash-wise, and then my profit's a positive cash. And so if I sum all of those, let's come up here and hit my sum, right? But I catch all of these, okay, and I can do that by holding down my left button on my mouse and just kind of dragging it over those. Hit my enter, and it tells me that my ending cash is $120,000. So my cash situation in that case wasn't very good. Now, being a former banker, I'd look at that and say, you know what, I will gladly lend you money for your asset build. If your sales are going to increase that much and you've got that kind of return on sales, right, I would gladly lend you money for that asset build. That wouldn't be a problem. Okay, And so while this points out a need for cash, it doesn't mean that the business is in any trouble in this case, right? So we move on, and I think you guys have number 3, and I just went ahead and did. You guys got number 3. I better take a look here as my machine slows down again. But I went ahead and did number 2, I think, which is much like number 3. You guys are going to have to answer another question. No, you guys have number 2. So I did number 2, I'm sorry, but I changed the numbers again. So Philip Morris expects sales, I'm going to do something kind of goofy here, expects sales next year. Philip notes that net assets minus liabilities, will remain unchanged. So in this case, we're not going to have that asset build, right? Like we did in problem number 1. His clothing firm will enjoy a 12% return on total sales. He will start the year with $150,000 in the bank. What will Philip's ending cash balance be? Well, I just changed the numbers here, and I went with sales of $200,000 as opposed to your $550,000. ROS 8%. Again, I'm just inputting stuff here. I'm not having to do any formulas except here. Then I come down to my increase in cash. Well, again, this is also my profit, and I could even put that here. I could say this is my, all right, and that's simply equal to my ROS, my return on sales, times my sales. Okay. I had a beginning cash of, I put $20,000. You guys have $150,000. Obviously, you got bigger numbers, so I just made it up. So I've got my profit, my beginning cash, and my ending cash in my case would end up being $36,000. So just a relatively simple problem. Basically, you're just adding your return on sales to your whatever your beginning cash was. Okay. Next problem you guys had is 5, and I went ahead and did 6, which I think is quite similar to your number 5. So we'll take a look at that. Number 6 says, oh, no, I'm sorry. I got to jump over. Number 6 is like your number 7, but 5 is, I made a separate example here. 5 looks like this, right? And it basically says that Bronco Truck Parts expects to sell, I think I did number 4 here, right? 70, yeah, I did. Okay, expects to sell, so let's look at 4, it's just like your 5. The Alliance Corp expects to sell the following number of units of copper cables at the prices indicated under 3 different scenarios in the economy. The probability of each outcome is indicated. What is the expected value of the total sales projection? So set up your little spreadsheet, outcome, probability, units, price, just like it has it here, right? Okay. All we're saying here is that we think there's a 70% chance that this is going to happen, and basically we're just going to average these. We're going to average our probabilities based on the units and prices that we would get under those scenarios. And so if this happens, right, there's a 70% chance. My price is $20, so I just take my 20 times my 225 units, right, equals my $20 times my 225 units, and I end up with $4,500. That would be my sales forecast in that case, right? And I can just copy this down, the formula, because it's the same, right? This one's going to be 35 times 370. This one's 45 times 510. So for those of you that know, you can grab that lower right-hand corner when that little cross appears on it, and drag it down, and that means copy. Okay. Then I get over here, and what I want to do here is apply the probability. Okay. All I'm doing here is I'm applying the probability of this occurrence, and in this case, then this then is equal to my $4,500 sales times my probability, which is 70%, which I should have entered as 0.70, right? I should have entered that as 0.70, and that tells me what my outcome would be. My average outcome, basically, is what I'm saying. And again, I can copy that down, okay, and that gives me the outcome or expected outcome under each of those 3 scenarios, and then I just need to total that. So I can hit my sum. It captures all those, hit enter. So my answer would be $9,035. Obviously your guys's will be a little different. So then we can jump to number 6, which is much like your number 7, which is assigned. Okay, so number 6 says this: cybersecurity systems had sales of 3,500 units at $75 per unit last year. The marketing manager projects a 30% increase in unit volume sales this year. That's outstanding. With a 40% price increase, that's even more outstanding. Increase in sales with a price increase? Oh, sounds like Apple. Return merchandise will represent 8% of total sales. What's your net dollar sales projection for the years? So we're going to have this increase in price and an increase in volume, but we are going to have some returns. We've got to calculate all those in. So again, I just started inputting some stuff. Last year's sales units were 3,500. Last year's price was 75. Last year's revenue I calculated. I don't know that we really need to calculate that for a problem, but I just put it in there because, again, I input my sales increase in units, my price increase there. Okay, so my current sales, or my sales for this year, what I'm projecting basically, are going to be equal to my last year's units plus the 30% increase. Okay, now there's a couple ways that you could do this. You could first say, I'm just going to come over here and use a blank square. I could say, okay, my 30% increase is equal to 30% times my last year's sales, which is 3,500. So my increase is going to be 1,050, and then I have to add that to my last year's sales, right? So for my current sales, I could say this is equal to my last year's sales plus my increase, my projected increase of 1,050, and I'd get $4,550 or 4,550 units. I'm sorry. Okay. Another way to do this, a shortcut, is just to say that this is equal to my last year's sales times 1, which is my last year's sales, 0.3, or I'll do it the longhand way first, times 1, or my last year's, I'm sorry, times 1 it should be, plus, can't hit the right numbers here, plus 0.3. Okay, so I'm taking last year's sales times 1 plus 0.3. The other way to say this, let's do it algebraically. Sorry, I'm just making this kind of odd, but you could take it times 1, right, which is last year's sales, and I should put that in parentheses, so I shall, plus last year's sales times 0.3, or my increase. Okay, and again, I need some parentheses around those. Okay, and that's equal to 4,550. Okay, that's a long equation. There's an easier way if you look at that algebraically. If you look at this equation up here, both of these are multiplied by B18, and so you can take it 1 plus 0.3, okay, or you can simply say this is equal to last year's sales times 1.3. That's going to give me the same answer every time. Okay, so that's kind of a shortcut. So I'll use the shortcut from now on. I just kind of wanted to run through that. So I've got the current price, or my price. My price is going to increase by 40%. So let's do that the same way, that shortcut. So this is equal to my last year's price times 1.4 in this case, right? Okay, and I could have said times 1 plus this. Okay, so then my current revenue is going to be equal to my sales times my price, simply equals this times this. Almost $500,000, but I'm going to have some returns. I just plug that in. It's 8%. That's given to us, right, in the problem number 6. And so then I have to calculate what that's going to be, and that's going to be a negative number. So I can simply do that. I can say instead of starting with an equals, I can actually start with my negative because I want it to show up as a negative, minus my returns, my 8% times my current revenue. Okay, so my returns then are going to be a minus 38,220, and now I've just got to take a total, right, of my current revenue minus that. But because I've put this in as a minus, I got to actually sum it or add these two together. So I'll just use my sum formula will work, and my total revenues are going to be 439,530. Okay, onward. So you guys have number 12, and so I did number 11, which is similar. On December 31st of last year, Wolfson Corporation had in inventory 450 units of its product, which cost $22 per unit to produce. During January, the company produced 850 units at a cost of $25 per unit. Assuming that Wolfson Corporation sold 800 units in January, what was the cost of goods sold? And in my case, I'm assuming FIFO. And if you read the chapter, of course, you'll know the FIFO means first in, first out. You guys will be assuming LIFO, last in, first out. So you're going to have to make some changes a little bit to your formula as compared to mine. But it will be fairly similar, right? So what I want to do again is start inputting some information as soon as my computer relaxes here again, and I can go. And what I'll enter in, ooh, where'd it go? Okay. I had my year-end unit inventory was 450. Okay, my cost of goods sold for that inventory was $22 per unit. Okay, so my total cost of goods sold for my inventory on hand at the end of the year was $9,900, which is just equal to my cost of goods sold times my year-end inventory. Okay. Now, in January, for my problem, number 11, I produced 850 units. Right? But my cost of goods sold went up to $25 per unit. So my total cost of goods sold for January, and actually I don't even need this, but I'm going to go ahead and do it, and I'll show you, okay, is equal to my $25 times my 850 units. So my cost of goods sold, and that's really not the right answer. This is not cost of goods sold because I haven't sold it yet. Yeah, so I probably shouldn't have even done that. This is just what my cost of goods are, right? Produced. Cost of goods produced, I should say there, because I haven't sold it yet, so my mistake. Shame on me. Okay, but I'm using FIFO, so I'm going to sell the items that are first in, my first produced items. Okay, I'm going to sell those first, and so I'm going to sell 450 of those. And I already know that my cost on those, my cost of goods sold is $9,900. So I can just copy that down here. I can link that. I can say this is equal to this. Okay. But I'm going to sell a total of 800 units, right? That's what my problem says. Problem 11 says I'm going to sell a total of 800 units. So I took a shortcut and I said, well, 450 old, I'm going to sell 350 then new units, or these units that are $25 a piece. Okay. So I know that my cost to produce these 350 units is $25 per unit. So I simply put that in here. This is equal to my $25 per unit times the ones that I sold. This is my cost of goods sold for January, actually. $8,750. Now I just have to total those two. And I get what my total cost of goods sold for those items in January, what that's equal to. So your guys' again is number 12, so you're going to have last in, first out, which is going to be kind of interesting, right? So it's basically the same, except that you're going to sell, you know, all of your last ones, the last ones produced first, okay? And why do they do that? They allow you to do that in accounting so that you can actually you can manipulate your ending balances a little bit for tax purposes is generally the reason. So, all right, then you guys have number 22, and I think I kind of did 22. Let me just check here. Nope, you know what? I went ahead and did 23, which is here, as an example, because 23 is a little bit more like your 22. 23 is actually a little bit more complicated just because we have more months. And what do we do up here? Well, okay, we could enter all these in. We wouldn't necessarily have to, because these are unit sales, which we have down here, and that would be fine too. Okay, so we don't necessarily need to list these all up there. This is kind of nice to enter in up here though, right? We've got inventory, next month's sales ratios. So what it says in my problem, and in yours as well, your guys is 150%, I believe, of next month's expected sales. Yeah, 1.5 times, which would be 150%. Okay, mine says 110%. Okay, now you got to be careful because 110% is entered as 1.10. Right? I hit enter. Okay, yeah, I've got it as a percent, so I'm sorry. I'm going to change that so that it's kind of back to, let me just hit general, right? Okay, if I hit 1.1, okay, 1.1 times then, and then I convert that to percent. Oops, I gotta get off and go back to it. Yeah. I'm sorry, excuse me. Huh, now it's not gonna change it for me. Great. 1.1 times is fine. That's equal to 110%. I don't know why it's not allowing me to control shift and percent. Huh. It won't let me do it now. I don't know why. Okay, I'll leave it because it's the same. 1.1 is equal to 110%. January beginning, which is my December ending, 1460. It gives me this information, my material cost per unit. $14, but that's paid 1 month after production. $7 is paid in the month occurred. Fixed overhead costs, $8,500 per month. March I have an interest payment of $8,500. June I have employee bonuses of $13,700. We break this down then. Let's break it down into two separate categories here. And the first one is going to be the units that we need to produce. Okay, and then we'll come down and we'll do the cash budget. So we put our numbers in here that we have from up above here. Now my machine's not wanting to go where I want it to. I'm sorry. Go up here. So I've got my numbers from up above, and I can plug those in. I could link those, right? I could say this is equal to C4. Yikes. What the heck did that take me to? I don't know. Wow. This one is equal to C5, etc. Okay. However you do it, and you can plug those in manually if you want. Okay. Now I know what my ending inventory is for December, so I went ahead and put that in there. I don't really have this labeled as December, but I probably should. Okay. And I know that also that my desired ending inventory is equal to 110% of next month's projected sales. Okay, so December they gave me. They said it was 1,460. I don't have to worry about if that's 110% of that. It might be, okay, but I don't have to worry about that. But from now on I do, and all I have to do here is say that this is equal to my, okay, I'm going to show you a little trick here too, my ratio up here. Now I've clicked on that, and I've left clicked this, and I've left clicked this one up here. I'm going to go up and hit my F4 button at the top of my keyboard. Okay, that puts dollar signs in front of both the C and the 11. What that does is it maintains that reference. Okay, meaning that if I change this, if I copy and paste this, it's always going to come back to that cell C11. It's not going to change, and that becomes important. I'll show you why in a second. But that's going to be times my February projected unit sales. Okay, cool. Now I can drag this. Okay, I can copy that over, or I can copy and paste it, whichever one. Now what's important to see is that, again, C11 stayed there, but this reference moved. It stayed the same from February to March, from March to April, April to May, etc. But when I hit that $sign, and you can put that in manually, but it keeps that reference the same. So when I copy, okay, you're going to have a lot of formulas actually as we do this then that are like that as we go through this class. And so knowing that, it's kind of a cool little trick. Okay, now when I come here, this is total units required, so I've got my projected unit sales plus my desired ending inventory, right? So I got to have a total there, so I just sum that. Okay, and again, I can copy and paste that or drag that, you know, all along there is fine. Okay, minus my beginning inventory, because I start the month with some, right? So I want to know how many I'm going to produce, and so in this case I can subtract what my beginning inventory was. So I'm just going to put this in as a negative again, minus, and my reference will be to here. Okay, I want that to be a sliding reference because this month I want it to be up here, that month up to there. So now that I've done that, I can just drag that along. Okay, and then my units to be produced is just this minus this, which I could enter a couple different ways. I could sum that because that's a negative. If I do it this way, I can say this is equal to this. I have to put plus because that's a minus sign, so it's plus and negative, and that's the only way that would work, right? Okay, or I could just sum those two, right? I could say that's the sum of these two. Boom. Okay, so there we go. There's my units to be produced all the way through June. Okay, then I do a cash budget, and I come down. I got December, January, February, March, April, May, June. I know my units produced are those. Okay, units produced, it gives me, I think, for December, if I'm not mistaken, consistent. Yep, it tells me at the very end there, it says that I had 1,100 units produced in December, so I just input that in there. This stuff I just copy down, right? I can just do that by saying this is equal to this. Okay, and since that's a sliding reference, you know, I can just go there and okay. Now it tells me that my material cost is paid 1 month after production, right? So my material cost that I pay here in January is actually based on my December production, and it's $14 per unit. So this is simply equal to 14. Again, I can click that and I can use my F4 button to keep that reference the same, times last month's units produced. And now, you know, this is a sliding reference here with a reference up there that stays static, but I've got my formula built correctly, so I can drag that now. Okay, my labor cost is just based on $7 paid in the month that it occurred, so it's $7 times my amounts up there. So this one I can just say this is equal to, and I need my $7 to stay constant, so I'll hit my F4 again, keep that reference, times my January, or the month that it was incurred, the month that it was produced. And there we go, drag that. Overhead costs are just $8,500 per month, that's given to us. The $8,500 interest in March is given to us. Okay, and the $13,700 bonus paid in June is given to us. Okay, then all I have to do is total these, right? Just hit the sum for those, and there it is, and then I can drag that formula down. Okay, that's how much I'd have to pay out. In this case, we're not doing a profit. We don't know what we're selling these units for and whatnot. It doesn't really matter. So that would complete our problems for Chapter 4. Let's cruise ahead, try to get to Chapter 5. I'm going to try to close down some of these things. Hopefully that will make it work just a little bit faster. And here we go, Chapter 5. Get up to the top up here. And I did these samples not like I'd like you guys to do them. I actually prefer each problem on a separate tab down here. It's a little easier for me to keep them apart. If you do it like this, I'm not gonna count you off, but I kind of like it the other way. So here we go for this one. You guys got two 3, 8, 11, and 13. All right. So I did number 1, which should be a lot like your number 2. And I guess I got to click ahead to the right page. This talks a lot about different types of leverages and whatnot. I got to admit, I never used these things in banking. I suppose there's places. It wasn't a conversation that we really had a lot of. When we talked about operating leverage or those types of things, or at least we didn't talk about it in the context that we're doing here. So we're going to run through this, do a couple of them. I'm not pushing it because, like I said, I didn't use it a lot. You would think this would be something you would use in banking, but we didn't use it a lot. So, okay, we'll take a look here, and we'll say that number 1 is. Sorry, got to get to the right page here. On page 146 is like your number 2 basically, but it says Shock Electronics sells portable heaters for $35 per unit, and the variable cost to produce them is $22. Mr. Amps estimates that the fixed costs are $97,500. So compute to the break-even point in units. So we'll do some basic things here, right? Just plug in. We got a price of 35. I got a variable cost of 22. My contribution margin, then, by the way, is $13. Okay. My fixed costs are $97.5. Gross profit, I'll also call that oftentimes contribution margin. Okay, $13, similar. Okay, so how do I calculate break-even point? Well, I went ahead and put the formula in up here because they've got the formulas kind of given to us. Just my fixed costs divided by my gross profit per item. Okay, contribution margin I would normally say is the per item thing, whereas gross profit would normally be if you were doing an entire worksheet, if that makes any sense. So my break-even point for number 1 then is simply my fixed cost, so equals my fixed cost divided by my gross profit per item, $13, right? I got a break-even point in units of 7,500. Okay, it asks me to go ahead and plug those things in just to show that it actually works. So what's that mean? Well, it means if I sell 7,500 units at $35, okay, and my fixed costs are $97.5, my variable costs I'm going to have to calculate, but they're $22 per unit, I should end up with a 0. So let's take a look and see. So I got my sales are equal to my break-even units times my price, 262.5. My fixed cost is simply equal to, and I'm going to put it in as a minus my fixed cost just so it shows it's a negative, and my variable cost again, I'm going to click a minus my variable cost per unit times my number of units, that, and I sum those up, and I end up with a 0. Which is exactly what I'm supposed to end up with. So there you go. I think your 3 is very similar. Okay, it's just trying to confuse you a little bit, and it's got rent and it's got executives under contract. Those are actually both going to be fixed costs, right? And then you've got a factory labor $4 per unit, raw material of $1.20 per unit. So your variable cost per unit are $5.20. Okay. And your sales price is $13. So if you create that and you do those calculations, you know, you're going to come up with the same thing. They're just trying to confuse you. And you could sure have 2 separate costs, or you could have your fixed cost of rent, and you could also have a fixed cost or a cost of executives under contract. Okay, you'd have 2 things and make a little longer formula, or you could combine them. Either way. Jump into number 7. Which should be similar to your guys' number 8. But Callaway Cab Company determines its break-even strictly on the basis of cash expenditures related to fixed costs. So, yeah, we get a lot of places like to do that because you get things like depreciation that are not cash expenses, right? They are expenses, just don't take cash. So its total fixed costs are $450,000, but 5% of this value is represented by depreciation. Its contribution margin, price minus variable cost for each unit, is $4.10, okay, or gross profit per unit, right? How many units does the firm need to sell to reach the cash break-even point? So Yeah, I'm just going to enter the information first. I know that my fixed cost is $450. My depreciation is 5%. So now 5% of my fixed cost is my depreciation. So I put this aside and I set it over here, and I said, okay, well, that's equal to my depreciation times my fixed cost, or $22,500. Okay. So then my cash fixed costs, because I took my depreciation out of there, just my fixed cost minus that depreciation amount. So it's equal to this minus my depreciation amount, or $427,500. My contribution margin's $410, or gross profit per item, right? However you want to call it. And remember, I have my break-even point then as my fixed cost divided by my gross profit per item. So simply to do my break-even, I say this is equal to my cash fixed cost divided by my contribution margin. Bingo. 104,268 units is my break-even. Okay, onward we go. You guys have number 11, and so I did number 10. And this is where we get into these degrees of and whatnot. So I actually put the formulas in, and I put them in down here. I just kind of typed them in so I'd have them for a reference. You might want to do that as well. It's kind of nice when you're doing it here then, and I'll kind of show you what I mean. So my number 10 talks about the Sterling Tire Company and its income statement for 2013, and it gives us a whole bunch of stuff, right? Okay. And I just kind of took out the information that I'm going to need to do my formulas, right? And so I need to know what my quantity is. I need to know what my price is. Okay, and that's given to me. My quantity is 20,000 tires. My price is $60. My variable cost is $30. My fixed cost given to me is $400,000. My earnings before interest and taxes is $200,000. It's given to me. My interest is $50,000. Okay, and that's all the information then that I need in order to complete this stuff down here. Okay, so we jump in and we go, okay, my degree of operating leverage is equal to my quantity times my price minus my variable cost. Now if you read this too, you could shorten this, because it's saying that your degree of operating leverage is equal to your quantity times your gross profit per item, or contribution margin, right? So my price minus my variable cost is $30. My contribution margin then is $30. Okay, so you could do it that way too, which would shorten this equation up. Okay, divided by the same thing, quantity times my contribution margin minus my fixed cost. Okay, so you can plug the whole formula in, which I did up here. Okay, I've got equal to quantity times, and you got to get all your parentheses in the right place. So I'll do one of these and I'll show you. This is equal to, okay, my oops, I better get my parentheses right, just like I have it in my formula over here. My quantity times parentheses my price minus my variable cost parentheses divided by my, oh, I gotta have a couple parentheses, nope, just one, divided by my quantity times parentheses my price minus my variable cost parentheses minus my fixed cost and parentheses. Now hopefully if I entered everything in there right, I'll hit my enter button and let the computer go to work, and oops, I had a typo. Oops, I needed two parentheses at the end here. Where was that one at? Oh, right here is where I needed the other parentheses. So, okay, so I think that's what it's going to fix. It did. well, actually I put it at the end, but it didn't matter. It worked out the same, so kind of interesting. Okay. Another way to do this might be to simply, right, quantity times price minus variable cost. I broke this equation down and I said, okay, quantity, this is equal to my quantity times my, in parentheses, price minus my variable cost, and parentheses, boom. Okay. And the bottom part of the equation then is simply equal to this minus my fixed cost, right? So I said this is equal to this minus my fixed cost. Okay. And so my degree of operating leverage would also be this divided by this. And so you get down here, that's a long stinging equation, and it might just be a little bit easier sometimes to do it like this. Okay. Now, onward we go then. My degree of financial leverage is simply, and all these equations, by the way, are sitting there on page 4. Right, so my degree of, or page 4, I'm sorry, page 143. Number 4, my degree of financial leverage is equal to my EBIT divided by my EBIT minus my interest. Okay, so this one's pretty simple. It is simply equal to my EBIT divided by, and I do need parentheses here, my EBIT minus my interest. So 1.33. Okay, now my degree of combined leverage. Okay, and so here we go. I've got a similar thing. Ooh, I got a wrong number in here though. That's interesting. I thought this answer looked incorrect. Okay, and so I got to fix it. Okay, and it is incorrect. Same thing. I got this. The top part of this one and the top part of this one are the same, right? So my quantity times my price minus my variable cost is 600,000. But now my bottom one here is equal to actually this, right? My quantity times my price minus my fixed cost minus my interest cost. Okay, and like I said, I'm sure this number's wrong, and so I got to fix this. So I'm going to say that this is equal to, right, my quantity times my price minus my variable cost minus my fixed cost minus my interest cost. I have no idea why I had the wrong number in there, but this one looks correct now. Okay, so 600,000 divided by 150,000, because that's this part here is 600,000 divided by 600,000 minus 400,000 minus 50,000. So 600,000 divided by 150,000 gives me an answer of 4. And you know how to check to make sure that's right? Because it's also equal to this times this. Makes it a lot simpler. Okay, my break-even point is my fixed cost divided by my contribution margin. Again, my contribution margin is 30 bucks. Okay, so I can just, this is equal to my fixed cost divided by my price minus my variable cost. There we go, 13,000, etc. Okay, onward we go. You guys have 13. I did 12, which is similar, very similar. There's one little thing that'll trip you up here if you're not kind of careful, and that is the pounds or price per pound. I think in your guys' case you've got that same thing, yeah, the cost per pound. And so be a little bit careful when you do this. So mine reads, number 12 says Healthy Food sells 50-pound bags of grapes to the military for $10 a bag. So my price is 10 bucks. I got that entered in there, right? They're 50-pound bags, so I put that up here. But it says that my variable cost is 10 cents per pound. Okay, so there's a little bit of confusion, and so my variable cost per bag, okay, is 5 bucks because I got 10 cents times 50 pounds. Okay. After I figure that out, I can kind of get rid of that up there. I won't need that anymore. My fixed cost is 80,000. My contribution margin, I went ahead and calculated, is 5 bucks, right? I didn't do that up here, and I did it down here because it might make some of these equations a little bit easier. Okay, so it asks me, in my case, it says, what's the break-even point in bags? Well, my break-even point is, oops, I didn't even calculate that, did I? Is simply, I'll just put it in here. Break-even point is equal to my, again, my fixed cost divided by my contribution margin. You got the formula right up there. Equal to this divided by this. 16,000 bags. Okay, so it asks me then to calculate the profit or loss on 12,000 bags or 25,000 bags. I also did 20,000 bags, just put them in here because that becomes important later. I'm going to need that anyways. Now, what's that tell me? Well, my break-even point is 16,000, so I got a number that's smaller than 16,000, I'm going to lose money. A number that's bigger than 16,000, I should make money. So I should make money on both of these. I'm going to lose money. I should have a negative when I calculate that. Okay, so just plug in my quantities, my price, 10 bucks, right? It's given to me. Okay, so my total dollar sales are simply equal to my price times my quantity. Okay, and I can just drag that down. Okay, minus my variable costs. My variable costs are $5 per bag, right? So in this case, and this is one of those where I'm going to probably want to keep the reference, but I'm going to use a minus so it enters in as a negative number. My quantity times my variable cost. And the variable cost part, I want to keep that reference the same, so I'll hit my F4 button. That'll do that, and then I can just drag that. Okay, and my fixed costs are given to me, so it's just a minus my fixed costs. And again, if I hit F4, then I can just copy that. Okay, now all I have to do, I got my sales. Here's my variable cost, here's my fixed cost, so I just add this total here, do the sum, sorry, over here, sum of these, 20,000 minus, and then 45,000 and 20,000 to the good. So there we go. And then I just have to calculate, according to mine, the degree of operating leverage and the degree of financial leverage, and then the degree of combined leverage. And it asked me to do it at 20,000 bags and at 25,000 bags. So, okay, again, now here I've got the quantity times the price minus the variable cost. Remember, price minus variable cost is my contribution margin. So I kind of made this just a little bit simpler, and I just said this is equal to my, you know what, I'm going to escape, and I'll just do, because I already did these, I'll do it for the 25,000 just to show you then. So this is equal to my quantity times my contribution margin, right? Price minus my variable cost is my contribution margin. I am going to need parentheses around those, so I'm going to put those in. Okay, divided by my, same thing again, my quantity times my contribution margin, parentheses, minus my fixed costs, which are right here. Okay, and I think I need one extra set of parentheses. I might not, but I'm going to put them in just to be safe. Hit my enter, and my answer there is 3. I don't really want a dollar sign, so I'll just change it to that. It's actually 2.78. Okay, so round it up. It's a good thing I changed that so I could take a look at it. So then my the degree of financial leverage is my EBIT, or my earnings before interest and taxes, divided by my earnings before interest and taxes minus my interest. And my interest was given to me. I don't have it up here anyplace, but it was 10,000. So this is just going to be equal to, on the 25,000, my earnings before interest and taxes divided by my earnings before interest and taxes. Oops, I need a parentheses there. Minus, and in this case it was 10,000 is what they tell me. Yep, annual interest expense of 10,000. I'm just going to put it in. I could have put it in up above and referenced it or something, but okay. And it gives it to me that way. So 129. So what's my degree of combined leverage? Actually, I'm going to just do it the easy way. Equals this times this. 3.57. Okay? So fairly simple way to do it. So And I think that's it. That's it for our problems. That was the end of it. So that should work for you guys. Hopefully it does. And give me a holler if you have any problems or questions. So if not, thanks and good luck and have a good day.